Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elonin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Happy Friday. Welcome to PreMarket Prep. Spencer Israel, Joel Elconin, and Dennis Dick. I've been looking forward to today for more reasons than one. It is not every day that the majority of the people on this show get openly crushed on a position. So here's what I'm going to say. If you are with me in Sofi, if you are with Dennis in Fisker, if you have your own big loser, listen up. Listen up. We are going to talk about what you do when you get smacked around hard, as is happening to both of us this morning, and rules that we live by to avoid blowing up. That's the theme of today's show. We got a lot of earnings. I mentioned SoFi, Disney, blew it away to my surprise, to be honest with you. Airbnb, a lot going on today. Ivan Feinseth is our guest. Drop us a like. Reminder, link to the Saturday PreMarket Prep special. Next Saturday is in the description. Check it out. Click it down there. Joel, bring up your charts if you can, please, and let's get to the overall market, and then we will get to the theme of the day, which is, again, how to survive when you're getting punished out there. Joel, good morning.
Good morning, Spencer. Good morning, traders and investors. Kind of a quiet session. We have the futures trading up $1.25, 9-point range. Not much to say. No downside till we take out the pre-market low. The all-time high, 44.59.75. If we're going to expand on the upside, first things first, let's take that out. I decided to look at the ETFs today because I don't know how many commodity traders we have. So it's my first time looking at the USO. We'll try this for today. USO trading up a nickel, 48.15. GLD trading up 60 cents at 164.64. The SLV trading up 20 cents at 21.70. Bitcoin bounces right back. That's up nearly $2,000 at 46,360. And Ethereum's bouncing back nicely too. That's up $183 at 32.43 in a quarter. So I guess I missed the first part of the pre-market show when you guys were talking about positions and position management. So Dennis, I know you're something that's really on your mind here. So let's cover it. Let's talk to people about these markets and risk management.
I mean, we always talk, strategy. We always talk about, what we like, technicals, fundamentals, different, stuff. And we're going to talk all that, on the 21st when we do our webinar. But I think we need to just go back to the basics because we have so many new traders, so many traders who have just started in the last 6 months to a year. And, a lot of these traders don't have any, formal trading education. I mean, we were prop traders. You were on the floor, Joel. I mean, we were taught, mentored from a lot of different traders that have been in the business for a long time. So I think it's important to just go back to the basics. So that's what we're going to do in the next 10 minutes or so, is kind of take you back to the basics. The reason for this is I'm seeing messages on Twitter, and you make a good point. A lot of people on Twitter are probably just making stuff up. A lot of it might not even be true. But I'm seeing multiple people talk about like stocks like AMC, and they're saying they put their entire retirement account in it. I don't know if that's true. But if you're 65 years old and you've worked your whole life and you're taking your retirement money and putting into AMC, you're asking for a lot of trouble. Yes, maybe AMC goes to 100. Yes, maybe it goes to the moon. That might happen. But what if it doesn't? What if it does go back to $10? What if it does reconnect with fundamentals? What if it doesn't go to the moon? Are you prepared to lose your savings? Are you prepared to lose what you have in that stock? Whenever I enter any stock position, I have in the back of my mind knowing that that stock position could go to zero. It could. Is Apple likely to go to zero? Probably not. Could it? Anything is possible. So I always consider, when I'm looking, the one key that I'm doing in all of my trading and all of my investing is I always stay diversified. You can make speculative bets in AMC. You can make speculative bets in the stock like Wish that everybody's talking about today. But if you're putting all of your eggs in one basket and putting 100% or even more on margin on one stock, that's a recipe for disaster, because what can happen is stock could get randomly halted, even during intraday. Come out with random news, gap down on you 50%. So let's say I have a stop loss, and I've got a mental stop loss. I'm going to sell this at 10% down, and I'm going to get out, so I'll be okay. I only have the potential to lose 10%. But if a stock gets randomly halted and falls 50% on you, you don't just lose your 10%, you lose 50%. Not saying that's going to happen. It's happened to me twice in my trading career intraday, where I have actually been in a stock that was intraday trading and got halted, and then had to move, halted for news, and then had a significant move in one direction or another. It happened to me once. I was short a stock and it got taken over, and the stock went up 80%. I lost 80% on that trade, which is, I was probably in the trade for 1 or 2%. It's just bad luck. But how I survived, that actually worked out to only 2 days of earnings for me. One, I was diversified, didn't have all the eggs in one basket. And two, I ate the loss. I just eat it. It's done. That was my out. I was only planning on losing 1 or 2%. I lose 80%. The stock got taken over. Nothing you can do. It's bad luck. But you've got to be prepared that the worst can happen. So when I'm reading about people putting their entire retirement account in stock like AMC, I'm just scared for people out there. I don't want somebody to, be on the wrong side and lose a lot of money. Yes, AMC might go to $100. Yes, AMC might go to $200, but it might go back to $1. It's possible. So just keep that in mind. If you want to make a speculative bet on it, go nuts. But if you're putting your entire retirement account in it, that's scary.
Yeah, and if it goes for Wish, it goes for Fisker. I mean, I'm in.
I want to bring it to Fisker in a second.
Yeah, I mean, you know what lets me sleep at night is I know that my SoFi position is like 2% of my portfolio.
There you go.
Like that helps me sleep.
It helps you so much.
Yeah, it's less now. Let's be honest, but it was 2%.
Terrible call by me on Fisker yesterday. People are saying Fisker is a speculative bet. You can bet. I just got done saying, let's rewind the tape to 1 minute ago. You can make speculative bets in this market, and Fisker is definitely a speculative bet. It's still pre-revenue, so it's definitely a speculative bet. How much of my net worth? I said it yesterday. I put 1%. Not even 1%. I probably was a 0.5% actually, but I'll go up to 1 or 2% if I'm really convicted. So, on Apple, I'm like 3 or 4% of my net worth is in Apple. It's just grown so much in my portfolio. I've trimmed it, but it just continues to grow, and and then you trim it again. But putting, I couldn't have timed it worse. I mean, I broke some other fundamental trading rules too. One, I was trying to catch a falling knife. You had the convert offering out there. It wasn't totally priced in yet. I'm trying to be a hero and thinking, okay, they've knocked it down $1. That's what it's worth. Trying to be a hero. So trying to catch the falling knife. Wrong. Stock continued down another 2 points. So I bought this at 17.30. It's now 15.20. And one day I just lost 20% or 15% of my money. But you know what? In the big scheme of things, it's not much at all, because one, I stayed small. I'm diversified. Terrible call. Couldn't make a worse trade than that, losing 15% in a day. It's a terrible trade. But as long as you're staying diversified. And two, I don't intend to add to the loser. Sometimes when I come in with a half-size position and it kind of was a smaller position, I might add some. But for the most part, I do not add to losers. It's a loser. It's a loser. I don't need to add to my pain, because you know what happens when you add to a loser? That's how small losers become big losers. So sometimes they come back, and we can go into, a story of another trader at Bright Trading in a second. But I want to get your thoughts here too, Joel. I think you agree with me on some of these fundamental rules about diversification, not only in investing, but in trading. And then two is, risk management, and just not just saying, okay, well, it's fell and I've got to buy more to get my average cost down. I mean, these are fundamental rules of long-term traders that are being broken here by a lot of people. And you're seeing it today in Wish, where the stock is down 25% on a bad earnings report, and people are just adding more, trying to bring that cost down. And maybe Wish comes back. Maybe it becomes a $10 stock or a $15 stock or a $20 stock again, but maybe it doesn't. So I think you just got to be prepared for the worst always. So Joel, I want to throw to you. What are your thoughts here?
You touched on so many different things here. First of all, for long-term investing, I mean, in your larger accounts, I mean, diversification is the only way that you're going to survive. And chances are, if you do something, if you do put on a big position in something, you know what? Chances are you may be right, but your timing may be off. And if you have such a large position, and this could be either in your own portfolio or day trading, that you're not thinking clearly. You're not, because you're so jaded. So even when the opportunity comes, maybe to exit or your original target, you don't take it, and you're greedy. So it's really the mindset of when you have in your overall portfolio. I mean, if the market went to 2000, FSP went to 2000 tomorrow, well, yeah, I would take a huge haircut across the board. That's much different. But for day, and I'm Dennis, I'm also a little bit more skeptical than you are of the social media and the Twitter, and it's just bots out there that maybe don't have a position at all, that want to see what Dennis and Joel and Spencer are thinking. So I know there are people doing that, and we discourage it. I just think that with this whole social media trading, there's just so much pumping and dumping and algorithms trying to figure out what people.
Book. I mean, this is what people, and we all talk our book to a certain extent. But there is so much pumping and dumping in social media, where you literally have people and Reddit is trying to fix that problem, and credit to Reddit and credit to Wall Street Bets that they're moderating this now, because they're just trying. Somebody will buy a big position of stock and they're trying to get it to get hot on Reddit so that their stock will go up, and they're trying to promote it. It's just blatant stock promotion. And this is where social media has really, caused, you always saw stock promotion via email newsletters and this and that, where you've got, and the way these pump and dump works, I think they're just pure evil. I think these people that are doing this kind of stuff are just evil. But the way that they work is they'll load up a stock and then they pump it out to all their, followers or whatever. Yep. And then they sell into that. Now, there's a lot of people who talk their book and they're not actively selling into that. So it's not a pump and dump. They're not dumping. But I mean, there is a lot of people out there doing this type of stuff, and this is actually illegal. This is stuff that regulators look for. So there was somebody charged, we talked about it 6 or 9 months ago on Twitter, that was actively saying, oh yeah, buy this stock. And then he was selling it at the same time he's telling other people to buy it. That's, illegal. But I mean, this is, goes into another thing that you were saying, Spencer. I mean, just blindly following Twitter gurus or blindly following people into, their trades, blindly copying other trades is difficult as well. You've got to do your own due diligence. You got to do your homework. People who are blindly following me into Fisker yesterday at 17, they're immediately down to 15. They didn't do well with that. And, and I tweeted it out. I said I added to the long-term account. I don't intend to sell those shares, but I think there is fundamental value here. I agree with Morgan Stanley, but that doesn't mean my timing is going to be right. My timing couldn't have been worse yesterday. So I mean, you've got to do your own due diligence. You got to do your homework, and you just can't blindly follow people into trades. I mean, that's what we try to do on this show, is try to educate, not just give out, oh, what do you like? What do you think of this stock? I want to buy this stock. I mean, we're trying to give some stock opinions, but we're trying to educate so you guys can become better traders and make those decisions on your own.
Yeah, because you can't be there sitting there pushing the buttons, every single thing different. I mean, a lot of Dennis's positions are hedged too, so there's, different factors that he's looking at. But no, I mean, you're making a great point there. And I think that's another thing where on our show, like who do we have? We don't know our audience well enough. Do we have, scalpers? Do we have, swing traders? Do we have long-term investors? And do we have a couple hundred guys in here from Wall Street Bets that are taking the information and then using it? I'll just say one thing. There was one trader that reached out to me, and I've been keeping in contact with him and some of the stuff. And when I talked to him, what he wanted was, he's made some money in the market. He started listening to us during the pandemic. But what he was more, he on the days he get killed, he goes, I just want to get killed less. I have these gains and things.
Yeah.
Like, what things do you want to? He has his own strategies, his own things that he does. But he was just like, he just wanted to avoid getting killed.
Sorry.
And that was, it's like pretty, we talk about some different things. He trades some speculative stocks and everything, but he also had some goals with his account when he originally opened up the account during the pandemic. He met his goal with that account, and he took some chips off. He took the chips off the table. The market did go higher, but he had set a goal with the money, with the capital that he put aside. So there's a lot of different things that you can do. But and what Dennis is doing, he's talking about your own due diligence, entering trades, and having parameters, and we could talk about that more. Yeah, risk parameters.
I mean, you're making such a good point, and I'll tell you today how you can get killed less. Those 2 rules that I just tweeted out as well: diversification in your trading portfolio and not adding to losers. That will get you killed less in your overall account. You're going to have drawdowns on individual stocks. Don't kid yourself. Like that stock that I got taken over on me, and I was up 80%. But imagine if I'm short a stock and I got 100% of my money in there. I just lost 80% of my money. I don't want that to happen. I want my account to build over time. And I mean, it's all about, some people are trying to get rich fast, and they're going lottery tickets on AMC stock. And if you just want to throw your lottery money into something, that's one thing. It's quite another thing to take all the money you've earned over the course of your working career and then dump it all into AMC stock because somebody on Twitter said it was going to the moon. I mean, that's another thing. So you've got to use, you've got to use some type of risk management in everything that you do. But, just to review, diversification is key and not adding to losers. And I do want to tell a story about a trader that we had at Bright that would add to losers consistently. And it was amazing. Like for years, this trader lasted years doing this stuff. Would start with a couple hundred shares. If it went down, they'd buy another 200 and the stock would come back and then you get their money back. If they bought 200 shares and it went to 400, then it'd go down a little bit more, they'd buy 800 shares then. And you know what? It would come back and they'd get their money back. And I was like, this trader never loses. I mean, he just comes back and he gets his money back and he gets his money back. And I was like, it's amazing that, again and again and again, just by doubling down and doubling down, he continues to get his money back. But one trade eventually did not come back, and that trader blew out their account. So eventually it does get you. That strategy of doubling down, inevitably ends badly, because you'll eventually get in the one that doesn't come back. And if you're doubling down, all of a sudden you're all in on one stock. You might just have picked that stock that isn't going to come back. It'll raise your winning percentage by adding to losers, but the problem is all those winners, or getting your money back, is not going to make up for that huge loss that you're going to endure inevitably with that strategy. So that's why in my trading account especially, I never add to losers. Never.
Key word there is that I thought was in my trading account. These are different, we talk about trading versus investing or different things. We're not saying...
I'm going to argue with you and say no. I rarely in my investing account add to losers too, because if I'm adding to losers, my thesis is probably wrong. I mean, if you're coming in with 10%, okay, so you're right. If you're coming in with your 10% of your position, I'm going to buy this 9 times like a Kathy Wood style.
Yeah, that I was
okay with it. Yes. I'm okay with it then. But if you're coming all in and saying I'm long term, I can know to put a double size position because I know in the long term it's going to come back. I wouldn't do it that way. So I would say you can be correct if you started your position with like a half size or a quarter size, and Kramer says that. I'll give you that. Is that what you were going to say, Spencer?
Yeah. I'm. One of the things is like, there's no rule that applies universally all the time, right? So I'm just trying to like hedge a little bit, and I'm not saying never ever. I mean, you might never ever add to a loser. That's fine. I'm just saying for,
I support Spencer in that a little bit. I mean, I do agree that a lot of the times you don't want to do that, but if you have some cash in your account saved for moments like this, that's what I necessarily try to have, at least some margin available to me if I need it.
Well,
I always try to keep some cash.
I do like what Dennis said.
That's diversification too.
I do like what Dennis said. If the plan is I'm going to buy this, I'm going to buy it once a month until I've got 10 grand invested, then if that's a plan, then fine, right?
Yeah.
That at least that's a plan. But if the plan is panic buying because
to bring your cost basis down,
right, then that's not the plan.
And that's a trouble. And I mean, people think, oh yeah, they got to be right 100% of the time. What about the Renaissance quant fund? What wasn't Simmons' winning percentage something like 51 or 52%? And you read the book. I never heard you gave it to me. But I never read the book. Wasn't it like Spencer? Wasn't it like 51? Shat, help me out here. His winning percentage was not like 80% or 70%.
It was like low 50%.
Low 50%, like 51. Imagine and Simmons puts like all of his eggs in one basket, and he's wrong 49% of the time. He didn't make all this money by staying going all in on a stock. He made all this money by diversification. Having core strategies and doing them again and again. And that's why my Bright trading account, it's very diversified. On any given night, I might make 100 different trades, and I've got all different trades on. Like overnight, I'm light. It was a very slow night. It was one of the slowest nights of the year. I have 34 overnight positions, though. So, I mean, I'm fairly diversified. All of there are fairly small bets, 1-2%. Like people are saying, oh, you can go 100% in your trading account, but you can't. Because if you're doing that, you might run into that moment where your stock gets halted, random bad news, and it gets you. And like I said, that's happened to me twice in my trading career. It can happen. Over 20 years, it only happened twice where I've been randomly halted. Like I've been through halts that I knew like earnings were coming or something like that. But, where randomly I'm just in a stock for a day trade and all of a sudden it just randomly gets halted out of the blue. Random news. That can happen too. So I just want people to be approaching this with at least the basic rules that, govern successful traders, at least from the traders that I've, taught and the traders that I've, traded with over the years. Because I think if you're sitting here and you're always going to, be adding to, your losers, and you're going to see your win percentage go up, but you're not going to necessarily see your P&L go up because those losing trades are just going to be enormous.
So last night, I'm sorry, Joe, go ahead.
No, I was just going to say we've had this discussion with Sean Udall too, and he has approach with the longer term approach. I mean, when he looks at a stock, I mean, he's looking at an area, and he puts his tranches, and he uses his technicals to and he does get stuck with stuff, but like when he goes into a stock, it's not, he'll go 10,
he's
20.
going with partial positions.
Exactly.
Kathy Wood style.
Exactly.
I'm going to buy a piece. I'm going to buy another piece. He's not going all in with, if he wanted 100 grand or 200 grand in the stock, he's not going 200,000 in, and now I'm going 200,000. So maybe we should just take it to numbers just to clearly explain it.
Sure.
Let's say you want to put $100,000 into a stock. You could go the Spencer Israel approach and say, I'm going to buy 10. I'm going to buy another 10. I'm going to average myself, dollar cost average myself into this position. That's quite all right. But if you're going in and say, I want 100,000 in the stock, and you put 100,000 in at one shot, which I do sometimes, but if it comes down and goes down 10%, I don't put another 100,000 in because that wasn't my plan. It wasn't my plan to have 200,000 in the stock. It was my plan to have $300,000 in the stock. It was my plan to have my entire trading account in this one stock that continues to go down on me. Those are recipes for disaster. So we just want to stay diversified, and we want to stay, with the adding to the losers, you want to stick to your plan. So, I'm fine with adding to losers if that was part of your original plan, that I'm going 10%, 10%, 10%. But don't adjust your plan and say, well, I got a little bit more money. I can afford to put more in this loser to try to bring my cost basis down. I mean, the mental capital too, Joel, which we didn't talk about.
Excellent.
That just murders you. Like if you've got this one position that's just weighing on you, it's going to affect everything else that you're doing. I mean, when you got 1% of your net worth in a stock, it goes down 50%. You only lost 0.5% of your net worth. It doesn't even really bother you that much. So it keeps your mental capital fresh. So you get into the next idea. And what Mitch was talking about, having cash on the sidelines, that's diversification in itself, and having a new fresh idea, new capital to work for the new idea. I always want, to be able to, buy stocks too. And I always have a chunk in cash just in case, we have, and even in the long-term portfolio, I have a chunk in cash. Trading and investing are two separate animals, but a lot of the rules can govern both.
Esther put a bow on this. She said, bag holding was a huge problem of mine until I realized that it wasn't worth the psychological effect, and not to mention the opportunity cost missed out while being in a bad trade. I think that really, really puts a bow on it.
If I could just, Bagwell has like a practical question here. So if in my day trading account, I got caught and am down, would the play be to slowly sell off as the price comes back to the stock, assuming it does, and space out the pain and possibly watch it gain more, hypothetically? So what do you do? Well, I know what you do, but like you wouldn't let yourself have a big loser in the trading account, but
no, it wouldn't happen.
I guess that's the answer to the question. But like, let's say you, for whatever reason, you broke your own rule. You have a 10% loser in the trading account, or 15% loser in the trading account. What do you do then?
See, you got to have your contingency plan when
first.
You enter. So I know where my out is. When I'm scalping and day trading, I want immediate gratification. If I'm entering something on a catalyst, on a news headline, I've got an opinion on that news headline that is telling me it's bullish or bearish. So I'm going to short if I feel like it's bearish. I'm going to buy it if I feel like it's bullish. If it starts going the wrong way, it's telling me that it's telling me immediately that I've interpreted the headline wrong. So I'm going to do everything in my power to minimize the damage from that position. Basically, when you have 50 or 100 over trading positions or day trading positions on, all my job is, people often say to me, how do you manage 100 trades, or how do you manage 200 trades? I just trade the open, and sometimes I get filled on 200 stocks. All of a sudden, 0 to 200 stocks. What do you do? What do you do when you all of a sudden just bought 200 stocks? You think I can humanly manage 200 positions? The first thing I do is I look at my net exposure, because I'm so big at that point in time that I'm probably linked very close to the overall market. So all of a sudden I buy 200 stocks. Am I long or short? Am I long? If I'm long $2 million worth of stocks, I'm probably going to go out and short $2 million worth of SPY. Because I want, in that position, I trade market neutral. So I'm always trying to stay somewhat hedged to try to reduce market risk as much as I can. But the first thing I'm going to do is, once I'm hedged, okay, I've reduced my market exposure. If I wanted $2 million worth of longs, that's different. But I might have been in, just playing the opens, and stocks open too low relative to where the S&P is. So I'm trying to extract the alpha from that inefficiency. So if my stocks open here and the market opens here, I want to extract this alpha. Well, you could just buy here and say, yeah, the stock's going to come back up. But what if it goes the other way and the market comes back down? Then obviously I'm not going to make money and possibly lose money. So one, you've got to know what you want your exposure to be. So I might hedge over the overall exposure. But then two, I go into risk management. I manage out of the losers. Winners are looking after themselves. Stocks working my way. I can let that, go. But I see stocks, okay, this one's ugly. I got to work out of this one. And I'm trying to manage the risk and trying to work out of my losers as best I can. But it's always the losers that I focus on first. Take care of them. Winners take care of themselves.
Okay.
All right.
All right. Let's talk. It's 8:30. We have Ivan Feinseth on in 5 minutes. So let's talk one individual stock if we can today.
Yep.
Get to one. I mean, we'll get to more than one.
Sure.
Let's just start with Disney. Okay. Joel and I probably couldn't have been more wrong. Could we have been more wrong?
It's wrong day. We're all wrong today.
It's Friday the 13th, man. We should just turn the show.
Why didn't you tell me that yesterday?
Yes, Spencer. It's all Spencer's fault. It's
Friday
the 13th. You know what? I'm disabling all my accounts today. No, go ahead.
I'm not mad that I'm wrong because you guys know that I'm long Disney forever. But I thought there's probably no way.
I'm talking about.
There's no way that Disney can come out and say that their Disney Plus subscribers.
That's what I said.
Growth is growing, and that's exactly what happened. Disney Plus subscribers somehow came in above Wall Street's estimates. 116 million is what they reported last quarter. It's not even that number that's so important. It's the fact that the growth rate from Q2 to Q3 was greater than the growth rate from Q1 to Q2. So the growth rate is increasing. If you recall, way back when they launched Disney Plus,
as we were reopening a bit too,
which
is even more impressive.
I know. So if you recall, when they launched Disney Plus, what 3 years ago or whatever, 2 years ago, they said in 5 years we think we can have 60 to 90 million subscribers. In 5 years, they said that. They're already at 116. Okay, they have blown those initial estimates out of the water. And it's not universal. Hulu is on a 3-quarter streak of losing subscribers. So, it's not universal to the whole company. But Disney Plus is just a monster. It is a monster service. On top of that, the parks are opening up. They were, return to the whole thing, right? I mean, it was a great report. That's all you can say about it.
It's the ultimate reopening play, but it has they're hedged to a certain extent. Just as we got done talking about being hedged, Disney Plus hedges them to a certain extent with COVID too. That's why the stock, has obviously, come back to make new all-time highs just a while ago. So I don't own the stock. I still want to own the stock. I've wanted to own the stock for a while. The whole Delta thing has spooked me on this. Maybe a mistake. It got down, and we were saying the major support at 170. Probably should have struck at 172, 173. I did not. But I mean, this is a stock that's, you think about eventually will have an awesome reopening. I'm scared on the parks. I'm scared with what's happening in Florida. It makes me hesitant to just come in and buy Disney, but they do have Disney Plus. So you still are getting, obviously, that Netflix type of business within this. But, you think about if we get to full reopening, then they have everything working for them. So I can see a scenario once we do get past COVID where Disney could be a $250 stock. I can totally see that scenario. So do I want to own Disney? Yes. I think the timing of it isn't today. I don't like buying reps. And two, I'm still concerned about the Florida Delta situation. So that makes me, not strike right now. But on pullbacks here and the COVID situation starts to look better, which hopefully it's going to soon, I'd own Disney.
Yeah, I'm looking at the pop here, and maybe you'll see this level again. 189.88 is your pre-market high. You've reached, actually after hours high, you've leaked $2 from there. So, that will be a good target. If you think, I don't know, I just look at this, the big move, the way it's traded. I just think this 190 to 192 area. I mean, yeah, you can buy it here at 187.50, but I don't know where my out is. Like, if I want to sell this at 190, let's say I want to buy it at 190, I buy it at 187.50. I could put $1.25 stop out there or something, but I have no idea where to buy this stock. If I was long it, I wanted to exit today, or I had some juicy options, I would say, man, I'd love to see that pre-market high. I'd love to see it. There's got to be a ton of paper at 190 too. I'm sure you can't even
let's
see
go look.
that.
I might be. Yeah, I might be.
You think you could see 190?
I'm going to the book.
And then
right
they got to
now.
sweep the book all the way from I mean, it's traded a ton of stock, right? But man, just thinking what's in the.
My book doesn't go quite deep enough.
No, it's traded 360,000. I don't know how much it traded last
421
night.
now.
What?
421,000 now.
Yeah. Okay. Your volume must be, so that's a lot of volume, but man, what can you see in the book? I mean, there's got to be stuff there's got to be some paper.
It's littered everywhere.
Yeah.
Oh, yeah. It's littered everywhere. Nothing major, though. Not major. Like you're seeing 5,000 here, 5,000 here. It all adds up to a certain extent. It can open up. I don't challenge it can open up at 187. This is Disney.
Yep.
It has been trading up there for a bit. I think you're right with the 190 number. I'd imagine there is some big size. I think it'll struggle there. So do I want to buy it at 187.50 with upside of 1 to 190? It's only 2.5 up. So that's where, again, I always, tend to sell the rip anyways. But in this case, I'd want a little more room to go. And, if it was 183, maybe you got 7 points upside to 190. Well, I only see 2.5 points of upside to 190 here now, which makes me less inclined to buy the rip. But there's room to 190. I would probably be looking to short the stock if it got up to the 190. Or if take out 190, then it'd be a different game, because if you take out 190, then you start thinking 195. Think about the big hole numbers.
That's a big windfall. But okay, House of Mouse picking up those subscribers. And Mitch made a good point. To go to the movies, if there's a movie theater out there and there's something open, you got 4 or 5 kids. Well, you don't have to pay for popcorn, but you pay $10 for a Coke. That 50, $100, you can get the same thing at home. And the pay-per-view, I mean, folks, this is the way everything's going. The second game of the Notre Dame Toledo, the second game in Notre Dame season, and so they're going pay-per-view. Everything is going pay-per-view. Disney's ahead of it. Disney's ahead of it.
Yeah, Joel, we didn't mention ESPN Plus. ESPN Plus had 14.9 million subscribers as of the end of last quarter.
Yeah.
That's up almost, what is that, like 90% year over year? I mean, it's up from 8.5 million last year. So, yeah, that's like 90%, something like that. So I mean, just the future of sports is streaming. And I don't know what you stream sports.
And they lock up everybody. I guess they have a agreement with the. I mean we forget about it. ESPN. The old capped cities. Remember that, Dennis? Or you might still been in high school.
I know about capital cities.
Capital cities, man. That's
dating yourself again once, Joel. We got to get Ivan.
I read the ESPN book. I know about capital cities. Okay, let's move on. Let's bring on our guest here, Ivan Feinseth from Tigress Financial Partners. He's their CIO. Ivan, do you have thoughts on this Disney report? I think you do. I bet you do.
Absolutely.
Yeah. What do you think?
I'm a fan of Disney Plus. I was lucky enough in April of 2019 to go to the launch event in Burbank, where they first introduced the concept of Disney Plus, and Jon Favreau came out to talk about The Mandalorian. And the minute I heard about The Mandalorian, I said, this is going to be a winner. Just to say, his description was, after the fall of the Empire, a lone gunman makes his way across a lawless galaxy. I mean, need I say more? And I believe that The Mandalorian has been the major catalyst in driving subscriptions. They also have Mandalorian Season 3 coming in December, and they have 5 other Disney shows. I mean, Star Wars content spin-off shows coming to Disney Plus.
What's interesting though, this has been our biggest criticism, and it's not just from us. I think I've heard it elsewhere as well. Is when you stack up the amount of new content, the prestige content on Disney Plus compared to Netflix, HBO, there's a lot less of it. But Mitch brought up a good point. Is Disney's got the exclusive movies that no one else has.
Well, content is king, and Disney's the king of content. Look, everybody has favorite shows on Disney Plus, Netflix, Amazon Prime. I can tell you a ton.
Yeah.
But unfortunately, we don't have time to watch it all, and
No.
people have to pick and choose. And you really talk about the break. By the way, The Mandalorian got 24 Emmy nominations about a month ago. The show's incredible. The Book of Boba Fett's coming. There's something for everyone. And I have said from the beginning, even Bob Iger said he didn't believe that The Mandalorian was going to be as incredible as it was. From the minute I heard about it, I said, that's going to be a huge winner, a big driver in and of itself. But I said when Disney announced the launch of Disney Plus, I said they are going to out Netflix. They will surpass Netflix. And with Disney, you not only get the power of Disney streaming is not only the streaming service, which is great, but it's the halo effect that it can benefit from the sale of merchandise, the trips to the plays on Broadway, theater, studios, TV shows, and the theme parks. They can capture it in so many other ways that Netflix cannot. So Disney, I say, look, thank God that Bob Iger came up with the Disney Plus idea before the pandemic, because it did.
Oh, I know, timing. Yeah, the timing.
The pandemic, and so they survived during the pandemic. They're going to thrive in a post-pandemic world because everybody wants to get back out. They want to go on the Disney cruises. They want to go on to the theme parks. So Disney is in the right place at the right time.
I mean, to be clear, it wasn't all roses, right? I mean, I mentioned Hulu, which I don't know what's going on there. They're losing subscribers 3 quarters in a row now. So, and I pay for Hulu. I have no idea. They got great stuff, but I have no idea what's happening with Hulu. It wasn't like there was the world's greatest report. It was just surprising to me that the Disney Plus numbers were as good as they are. Especially,
I thought it was a great report. I did.
Especially within the context of Netflix, who lowered the bar for themselves, and Roku, who lowered the bar for themselves. They came in line. Fubo was strong, but I did not see the.
But unfortunately, everybody always wants to focus on one data point, and Disney, as most companies, are just more than one data point.
Yes, that's a great point, because 3 years ago, all anybody could talk about was, Disney, ESPN's in trouble. These carriage fees are so expensive.
Now, we were just talking earlier about all sports is going to go to pay-per-view.
Yeah.
Yep.
I mean, yes. Even if they don't go to pay-per-view and they go just to subscription and they only go on ESPN Plus. So the 2 biggest players, it looks like, are going to emerge for games to watch are going to be Disney's ESPN Plus and Amazon. I mean, Amazon has made the NFL deal. I think they have the soccer deal. So those are the 2. Soccer is globally the most watched sport. Basketball is number 2. So there's people who still want to watch sports and go to sports, but the opportunity for streaming sports is huge, especially if you want to follow teams on your home team on an away game. So there's a lot there, and Disney is so much more than streaming. And in fact, when Bob Iger introduced Disney Plus, he came out and he said he just took his grandchildren to see Cinderella. And he said that his grandparents had taken him to see Cinderella when he was he said, so 5 generations.
Generational.
Same movie. And by the way, his grandchildren's grandchildren at some point will watch the original Cinderella. So the staying power, the residency of their content is powerful. I mean, I am pretty old now, and I remember going to the theater in 1977 to see the original Star Wars and thinking that was the most incredible thing ever.
Yeah, I didn't like Star Wars.
Little kid going to see Star Wars for the first time.
Yeah.
We're on the line with Ivan Feinseth. He's the Chief Investment Officer at Tigress Financial Partners. One thing, I just want to note, I pulled up, I was looking at your site, and you left something out on your profile. You said frequent guest on CNBC, Bloomberg TV, and radio and Fox Business News, and you don't put Benzinga in there, Ivan?
Sorry, there's a lot of actuals we have to update. We're not as diligent as updating our website.
Let's go, Ivan. Come on.
You're too busy picking winners. And I want to congratulate you.
I like this type of show. And I like the show where you're just talking about stocks and how it goes kind of in other directions that encompass the market, the stock of certain companies and what they do and just what's going on in the world. So
Garmin, you made a call on Garmin a long time ago. And what are you thinking now? I mean, is it above your target? You still like it? What do you think about Garmin?
My report out the other day has a 12-month price target of 198. 12 months from now. So let's say next August, 198. So there's still more to go. This company is just innovating. They are in the right place at the right time for aviation, for marine. Believe me, you can't get a boat, but everybody that's buying a boat wants Garmin marine radar and GPS on it. People love their Garmin smartwatches, their Garmin golf equipment.
I should have got it.
Some of the
Two things before I let you go. One, when is this market going down, and what's going to be the catalyst?
Well, the catalyst always comes from something we don't see, and
Okay.
it comes out of nowhere. I mean, the big risk is the Delta variant or, a lockdown that derails the recovery.
Okay.
But what the support, everybody says, we've gone for over a year with not even a 5% pullback because we've now been so conditioned to buy the pullbacks, and that has worked. So the more buying the pullbacks works, the more people will have the buy the pullback reaction, and that will continue to support the market and drive it higher. I mean, there's so many strong tailwinds for the market, the great corporate results, the strong, the economic recovery. And by the way, I think once the Fed does start to pull back, it will be positive because it will show the economy is strong enough to stand on its own. But I have one new stock I would like to talk about. That's a $10 stock called Owlet. This company makes
symbol, please.
What's the ticker on that?
It's OWLT.
Okay, let's talk about it.
They make a high-tech baby monitor sock that monitors an infant's heart rate, pulse ox, temperature. It's really the high-tech connected nursery. They have a two-way audio and camera monitor for the nursery. They are launching a telehealth platform for new parents. They are launching a pregnancy band for the mother that not only measures the mother's heart rate, but up to two fetuses, I'm sorry. This company is going to be the go-to company. When you hear somebody's pregnant, everybody's going to run out and buy the Owlet Smart Sock.
For those wondering, this was a SPAC.
That just finished the conversion last month from Sandbridge acquisition to Owlet. So Owlet went public through the reverse merger into Sandbridge acquisition. So they got Sandbridge behind them, which has been a very successful asset management company. They got a great, passionate management team, and the concept for this came from the founders' concern of a generic heart issue that they wouldn't want because, infant crib death is the number one killer of babies. And this is, if you have any concerns, this is a must-have. This company is in the right place at the right time. That almost, every new expecting parent is going to be buying the Owlet sock. And I said to them, it's so cool that it almost makes me want to have more kids because I love tech and this is just a concept. So, check out the website and read about the company. And I think this is a great idea and a great company. And I think there's a lot of upside. They just had their quarterly results last night. They did just under 25 million in the quarter, do about 107 million in revenue for the year. They're projecting to grow to $1 billion in revenue by 2025.
Help me with my AT&T here. I took a small position in it. It's even smaller now. It had that rip, and then they cut the dividend. I was thinking, give me 5, 6, 7%. And then literally I'd been saying that for like the last decade. And then I put a little position in it and whoop. So they don't seem to capitalize on anything. And of course, Kramer calling it the worst company in the world ever. They got the HBO. Give me some hope. What do you think about AT&T? Most boring stock, but I'm in it. I want to know your thoughts.
I actually like the potential to reduce the dividend. They were targeting a 60% payout of cash flow. They're bringing it to 40. So maybe maybe the dividend was too high. And they said, well, they're paying out all their money in the dividend. They need to invest because the opportunity in 5G is huge. So maybe that's it. But I always say nobody's cell phone bill is getting any smaller. We are using our cell phones more, and so much will be dependent on the 5G high-speed network. It's just what supports the whole Internet of Things. It's what will support autonomous driving. So I think that maybe this change, the spinoff of their media properties into a separate company, so the company itself can focus and the investors can focus on the returns generated from their wireless and wireline business while you still get the benefit of the media service, because HBO Max is doing well too. There's a lot of great content there. And by the way, the streaming services are not a mutually exclusive game. People will, on average, they say consumers will have 3 services for up to $40 a month, which gives you a lot of content. So there's room for everybody. You know, Netflix, Disney Plus, and HBO Max would put you right there, and we had less than $40 actually. Even if you got the whole, it would be about $45, but not insurmountable, and you get a lot of content. In fact, the biggest problem is you don't have enough time to watch all the content that you'd like to. But so I think 5G and wireless connectivity and this whole 5G upgrade cycle with Apple, every time Apple always comes out with a new phone, that's going to be the peak. They said the iPhone 11 would be the peak, iPhone 12 is the peak. They've already projected a 90 million unit run rate on the iPhone 13, which is going to be announced next few weeks, up from the 75 million run rate of the 12. By the way, there's still a lot of people running around with iPhone 8s out there. The average iPhone in service is 5 years old.
Joel.
No, what did I get? I got something new, Spencer. I got rid of the 5.
Okay.
I'm on the 5.
One more thing, Ivan, before I let you go. You mentioned Apple, right? And I get things stuck in my head, and I can't get rid of them. And so I'm looking at Apple after earnings. Okay, great report, hit an all-time high. It's pulled back. Now, my technicals are saying, hey, holding 148 is very good here. So we can take out the 150. But it's like, where's, they could get so much from the iPhones and the iPads and, the earbuds and the iWatches and everything. But I think that Apple's next big push, and this could be huge, is Apple TV. And they got the eyes, right? And they got the ears, obviously, because people are listening. I think, and I'm not doing this much on much research, but I love Ted Lasso. Has anybody ever watched Ted Lasso? The show? That is I think that they're going to get in. I think they're going to get in this content arena, and they're going to take a little, they're already there. And, a little chunk from Disney, a little, they already have. What am I thinking? Is could that be a big catalyst for Apple, or am I just too Ted Lasso eccentric?
All the services, but I'll tell you what's coming on Apple TV. Scorsese, De Niro, and DiCaprio's next big movie, which is coming out next year, called Killers of the Flower Moon. That is going to be a blockbuster, and that could be
catalyst.
The Irishman. But yes, so that's you got De Niro, Scorsese, and DiCaprio. I read the book Killers of the Flower Moon. I did the audio book actually. I did the audio book of I Hear You Paint Houses, which is what The Irishman was based on. And followed that movie for 2 years before it came out. Same thing with Killers of the Flower Moon. It's about the Osage Indians and the birth of the FBI.
The first thing was it the Irishman? Was that the first one? Was Pacino in that one?
Yeah.
Yeah. Jimmy Hoffa disappeared like a couple miles from my place.
I heard
we're still looking for him.
Yeah, I heard you're still looking for him, Joe.
Yeah, I got some clues, but I haven't been able to follow through on it.
I'm sure. Ivan Feinseth is the CIO of Tigress Financial Partners. Ivan, thanks a lot for coming on as always.
Thanks, Ivan.
And I really enjoyed being on. Thanks.
All right. Joel, get him on the bio page. Get him, Joel. Get him.
That was good, Joel. What do you mean there's no Benzinga on that bio
I looked at
page?
it. I'm like, I had to clean off my glasses.
Should be number 1 on Benzinga.
Or just take all those others off. All right. Can we cover 2 stocks today?
Yes,
we covered one.
No,
we covered Disney. Let's go.
We covered 2. Let's talk about SoFi. We streamed the earnings call last night. Seems like there was 2 groups of people that were in the chat. There was Group A that was this is a fine report. This is an overreaction. Nothing to see here. There's Group B that was panicking. Why is it down? Why is it down? Why is it down? I am long the stock. Honestly, I kind of was in Group A. It didn't seem that bad. We are still waiting on the bank charter. Wait, what did they say? Did they say end of year or did they say Q2? I don't remember. I think they said end of year. Pretty sure they said end of year. On when they're going to get the news on the bank charter. That's kind of the only thing that matters right now.
Mm-hmm.
To my eyes, to my ears, it didn't seem bad. So what what does the chart say?
Chart says better hold 15, hasn't
Yeah,
got to
huge.
15. There's all those lows there. I could get, if you're not in it, you want to be in it, see how it reacts around 15. If you put all your money in it and your stop was 15.50, then get out, reevaluate. Don't think about it. See what happens. Needs to hold 15, in my opinion.
Airbnb, this one was crazy after hours. Here's what they said: their EPS beat, their sales beat. They said we expect Q3, which is the current quarter, we expect Q3 to be our strongest quarterly revenue on record, finishing well above
Jeez.
Q3 2019 levels. Well above is what
This is a tricky one. Look at that.
I know.
I want to own the stock. I've owned it once.
I do own
It's
it.
just the valuation. I just can't, you look at the market cap and you're just like, but you know what? It's a great company, and you got to pay up for great companies. And, we're always learning, like I've always been kind of like growth at a reasonable cost. I'm trying to figure out if this is reasonable or not, but sometimes you just got to pay up. And I mean, it's got a $91 billion market cap, which, when you look at the hotel industry, if you're doing comp on that, I mean, that market cap is huge, which means that you're paying for the growth, but the growth is there. The story is there. It's not going away. It works in COVID. It's a reopening. It's also a kind of a lockdown. I mean, the company, has done a lot of things right, everything right, really. I kind of want to own the stock. I don't know if I have the reason for it yet, though. Get my timing right, Joel.
I don't
Where
know.
do I buy this?
Gosh,
I don't know where to buy it. Well, down at 130 was a great buy. I've already played it once, 135 to 150. I kind of want to buy it again, though.
Well, first let me talk about the resistance. And if there's anything that you learn from the show, and if you're a 4 a.m. trader, you see these reactions, you got a huge pop. And it went to 156.84. Now, it's not perfect, but this high was 157.41. So you could have gotten done on that. But that's history. There's buyers out there. I mean, they slammed it. Doesn't look like it's going back down to the pre-market low. I would not be surprised if this turned green on the day. I wouldn't be surprised at all. And where's unchanged on it? I mean, Dennis, if you wanted, put a little piece in maybe. And then if it goes down, put some
Do the
more.
Spencer Israel approach.
Yeah.
But you always yell at me when I put a little piece.
No, it's when you
wrong.
sell half, Dennis. It's when you sell half.
It's when I buy half too, because you know what? That means I'm not convicted. So
Yeah.
it means I'm kind of like, I'm in the middle. I can't decide. I'm usually in or I'm usually out. I'm not really one of these like buy 10%, buy 10%, buy 10%.
Here's what I'll say. The valuation is certainly a serious concern to have.
It's nosebleed.
No doubt. Mm-hmm. If this company can survive a pandemic, then I think they're okay.
I think it's an alternative to hotels.
I think it's a stay at home.
There was a
reopening trade.
There was a brief moment. There was a brief moment last March where I think Brian Chesky, who's the CEO, admitted this. Like they didn't know if like they thought they were going to die. Like the company, like they were making they laid off a bunch of people. They had to raise a bunch of money. They were like, oh my god, we're really screwed.
Who is this?
This is Airbnb. They were in trouble. And then it ended up happening is they turned it around. But I mean, I was scared for Airbnb. I didn't own the stock, but I was scared for Airbnb last March for sure.
Yeah, well, we were scared for everything last March. I was scared on just the zombie apocalypse coming at us. But we've seen that Airbnb can still thrive in an environment where COVID is running rampant, which makes you it's still a reopening trade, but at the same time, like Joel says, it's kind of like a little bit of both. So I love the company. I still can't wrap my head around the valuation, but I want to own it. I kind of want to buy this dip today, but it worked on Etsy. I paid up for an Etsy valuation. I bought it on earnings dip. Sometimes earnings dips continue to go down, though it doesn't always work. So part of me says wait for it to digest the move, but then part of me says this might just turn around and be turn around and rip higher too on the report. So I kind of want to own it. Maybe you do. Maybe you just buy half, like Joel was saying. I'm kind of wishy-washy. I kind of want to own a piece. Maybe you do designate, you buy half, and then it pulls down to 130 and you buy your other half. But if you're going in, then you don't double down when it goes down to 130. Just like I don't want to break the rules I was just talking about. But if you're designating, I'm going to buy half today, and half of it gets back to 130,
Yeah.
I don't have a problem with that.
Yeah, and I think, just a reasonable target too. I mean, who knows the path? It could go down and make a new low of the move. But for right now, that IPO, that washout at 120 looks like a good number. Of course, that high 220. Well, why can't this stock not go back to 170, 171? Take back half of that move. I mean, the way it's only $25 away, and it's kind of bunching up on the monthlies. Maybe if you want to pick it up on strength, right near that pre-market high too. 157.41. So you can buy it on weakness, buy it on strength. But to me, it just looks like you had the reps, people took some profits, you came down, and now it just kind of feels like a step up buyer. But I did see a step up buyer in Clover yesterday, and I said, "Oh, this guy's bidding it." And Dennis said, "Oh, I think it's going to struggle at 10." And then as soon as he said that, the same sellers came out at 10 and never even saw that level. But I don't know. I mean, I had just going on my own experience in Florida. I like it. It was great. It was a smaller unit.
We've done Airbnbs a lot of times.
Yeah,
it
was a small unit. All new stuff in there, except that the TV was kind of funky. It was hard getting the masters. But man, brand new stuff. It had a little pool. Easy to manage. You don't need 25 people working at the hotel. I mean, we're gonna have smaller airplanes and we're gonna have smaller hotels.
Yeah. And their take is just huge. I mean, it's the same. Uber and Airbnb are basically the same type of business. Uber came in, disrupt the taxi ride industry. Airbnb comes in, disrupts the hotel industry. They have an app. They take a huge chunk. Like the margins are probably really good. I haven't looked at the margins, but I imagine they're very good. And, it's all just from putting, the two people together. Obviously, the person who wants to rent out their house and the person who's looking for a place to rent. I mean, the app does it all. Genius. I mean, just the way it works, the ease of it. We've probably used Airbnb multiple times. I've got a friend that rents his house regularly on Airbnb, and he complains about the take. And I mean, there is a huge take with it, which, is nice if you're a shareholder. So
the thing is there's no competitors. There's no,
and that's a question. Is there going to be, or is it going to be like you have Uber, then you got Lyft? Is somebody coming for
there
Airbnb?
There's Verbo owned by Expedia.
It's been around longer. But anyways, hey,
but
guys.
That's a name. Like everybody is like, all right. You got Google and you have some Bing, you have some competitors. You have Uber, you have Lyft, but it's still Uber. And then you have Airbnb, and you're going to have some other competitors coming, but is it still going to be Airbnb? I mean, at a certain point, it's a screaming buy. It's just at this point, if this got down to a $50 billion valuation, I'd be like, yeah, that's a buy. A $90 billion valuation,
it's tough. It's tough.
It's tough to wrap your head around the valuation, but if you can just ignore the valuation and say, is the story still intact? Yes, it is. Is the growth still intact? Yes, it is. Can this have the potential to get back to new all-time highs? I think it does. I don't know the path to get there. I don't know if it does for sure. Competition could disrupt that. But I like the story. I like Airbnb, the company. I'm wishy-washy on the stock at this price.
50. All right, I got to hop. I'll let you guys finish it up. Yeah. Hopping over to PreMarket Prep Plus to cover all these tickers. I think this is the least amount of tickers we ever covered. So hop over and we'll cover those symbols. And Spencer, I'll give you a call in a little bit. Everyone have a great day. Be careful. Friday the 13th.
50 billion in Airbnb would be an all-time low, so I don't know if you'd want to buy it there. But and then there was a great point in the chat. Who I lost the comment. I'm sorry. ADWTX. Yeah, there is definitely some real regulatory risk as it relates to local municipalities and Airbnb.
But, that's a good one because I was actually just driving. We were driving in a nice area, and there's on the water, Georgian Bay, and you're seeing people who have $1 million houses. And then they have Airbnbs beside them, and there's signs all over those neighborhoods, stop Airbnb. There's literally, because think about this. You buy yourself, you're independently rich, and you buy $1 million property on the water, and, you've got, your 100-foot lot, and it's 100-foot lots, and you got this awesome. And all of a sudden, the person who buys the property beside you is running an Airbnb, and you have parties there and all kinds of other stuff going on there all the time. How much would that be wow, I can't believe how much my neighbor has ruined my property. So that is, a concern in some areas where they're doing Airbnbs, and there will be municipality where, there's people There is already some rules with that for sure.
In New Orleans, they made a rule. They're like, you have to live in your house for the majority of the year in order to rent it. Like you cannot just buy a house and then rent it all the time.
Same thing with my father-in-law in St. Petersburg. He's got he's got a couple condos, and obviously he's Canadian, and so he just rents these. But he has same issue running in there, is that you can only rent for certain. He can't rent it all year.
Yeah.
There's certain times that he cannot, and that's because of Airbnb, and they don't want the neighbors that are just throwing wicked parties there, in a retirement community. So that is a risk for Airbnb.
Jason Razik said they almost bought a house this summer, I guess a vacation home, and the Airbnb went into the reason as to why they went into the calculation to rent it out. That's interesting. Yeah. And to those asking where Jason is, he's in the chat right now. We miss him.
We never see Jason anymore.
Tweet at him.
He's there. The Raz is there. He's hiding. He does so many things. He's so busy. You never know where that guy is. He's so busy.
Tweet at him, at Jason Razik. Tell him you miss him. You miss him on our show. And he's
always looked forward to the Raz.
He's welcome back. I have a calendar invite every Friday. It goes off at 8:40. Jason Razik on PreMarket Prep, and then it comes and goes. And I'm sad. So
he's busy. He's hard to get a hold of.
Yeah. Okay. Well, I'm gonna hop. Dennis, have a great weekend. Have a great day. We'll see you on Monday. I gotta hop, guys, as well. Here's what's gonna happen. This show will end live trading with Benzinga starting right now. Mitch, Ryan, Zunaid. I will not be there because I will be preparing for our show after that special show today. After live trading, we are doing our very first Benzinga All Access. This is going to be a 2-hour show, about 2 hours. And the idea is we spend so much time getting into the nitty gritty and into a company and the stock and the chart and the financials. And let's just zoom out and let's just talk about the stories for a second. And let's interview these companies and these founders and these CEOs about their story, and the story of their company. So we have 4 longer form interviews booked for the 10:15 to noon window today. That'll be happening after live trading. So no SPAC Hack today. We're going to do live trading. We're going to do Benzinga All Access. The idea is to take a deeper dive into the story behind the company, not just about the stock or the chart or whatever. And then after that, the day will proceed as normal. Power hour, get technical, et cetera, et cetera, et cetera. But I'll be prepping for that. So live trading with Benzinga is starting live right now. I'm ending the stream. Please smash that like button, and I'll see you guys in about an hour from now. How do I end this thing?